Hi everyone, I'm Irk and this is Get Irked, my channel dedicated to helping anyone learn how to invest for the long term without using day trading or risky strategies to do so. In today's video, we're going to talk about how much cash you should have in your portfolio. The question you might ask yourself is, why hold any cash? If you're going to be fully invested, you'll have the most growth. And while that's true, there is an adage that's also true. No one is able to time the markets. No professional can accurately predict when we're at a market top, sell their entire portfolio, and then wait until we've reached the market bottom and put it back in. So the best approach to take advantage of market volatility is to have at least some of your cash on the sidelines instead of being all invested. Personally, my strategy is to buy in stages and sell in stages. In other words, if I have a position that drops in price, if it gets to a price that I think it's appealing, I'll add to it. The same works in reverse. If I have a stock that goes up in price and I have a significant amount of profit in it, then I'll sell some of the position and take the profit. In neither case am I buying the entire position I want at the bottom, nor am I selling all of my position when I'm getting out. I want to have a core position that I trade around, taking advantage of the swings that a market will typically see over years. Now, while I say I'll never sell my entire position, that's only if I still have faith in the company. If the company has done something that makes me feel like it's going to go bankrupt, that it's a broken company, yeah, that's time to get out. If your thesis or story is no longer set in that investment, that's when you sell. The rest of the time, you should be buying and selling in stages, small quantities in both directions. But the only way you can buy in stages is if you keep cash on the sidelines. If the stock market drops and you're all invested, there's no way for you to take advantage of the lower prices. However, if you're holding 100% cash waiting for a 25% sell-off and the market goes up 35% in the meantime, you've missed out on all those profits. The only way to balance the two situations is to keep some of your portfolio in cash at all times. Every investor is different, so you have to determine for yourself how much cash you'd like to have. Now, although I'm not a professional advisor and I'm not a professional investor, what the traditional approach is to have 5 to 10% of your portfolio in cash at all times. In order to figure out how much cash you might want, you have to ask yourself a few questions. For instance, what's your time horizon? If you're planning a big purchase, like buying a house or paying for college tuition in the next 5 years, you might want to have more cash on the sidelines than you would if, say, you're in it for 20 to 25 years and this is your retirement account and you're not planning on retiring in the next 30 years. Some investors would prefer not to really think about it. They'd rather just have most of their money invested at all times and then have a little bit on the side for when the market sells off. If you're somebody who doesn't want to spend a lot of time doing this, 5 to 10% of your portfolio in cash is probably what works for you. That way, if you see a big sell-off, you can go in and buy a few positions, but the rest of the time, you're letting your portfolio work for you. What are the current market conditions? If the S&P 500 and the Dow Jones and the NASDAQ are all at or near all-time highs, you're likely going to want to have a bigger percentage of your portfolio in cash than if they were at record lows or one-year lows. The reason is the likelihood that the market will sell off when they're at all-time highs is much higher than the likelihood that it's going to go even higher. That being said, you don't know for sure, so you're always going to want some of your portfolio invested and some of it in cash. Remember though, the more money you have on the sidelines, the less exposure you have to the upside. So you really need to think for yourself how much cash do you want to have, and you might consider consulting a professional financial advisor to help determine exactly what figure that is for your strategy. While I'm not a professional, I have been doing this for 2 decades very successfully, and my strategy is a bit different from the traditional. When the markets are reaching their all-time highs, as they are at the recording of this video in March of 2021, I'm going to have a significantly bigger cash position than if they were lower. As an example, when the markets hit the bottom of their sell-off in March of 2020, I was still almost 40% cash, even at the bottom. And you might think, wow, that much cash, why didn't I go all in? Because as I said before, no one can time the markets. There were analysts who were actually predicting that we'd see 15, 20, 30% more downside, even though the S&P 500 was already down 35% at that point. Not knowing where the bottom is means that I have to plan for both contingencies. What happens if the market goes lower, and what happens if the market goes higher? Even being that much in cash, at the end of 2020, my portfolio as a whole was up 28% in comparison with the S&P's gain of only 16%. So you can have a significant cash position and still beat the S&P 500 by a large margin. Right now, I have nearly 43% of my portfolio in cash. Why so much? With inflation on the horizon, with money printing going on, and with all of the uncertainty, plus a market at all-time highs, I'm wanting to keep a pretty good percentage on the sidelines. In addition, analysts are predicting that we might be in store for a 90-year sell-off. Every 90 years, the market sells off significantly. The last time this happened, when you're talking about the historical theory behind this, was in 1929. These analysts don't believe the sell-off we saw in 2020 was significant enough. They're thinking we could see a sell-off of 50 to even 80% from these levels. So in that, I want to keep a decent amount of cash. However, that being said, there's no way of predicting whether they're right. So if they're wrong, I'm still going to be buying in stages on the way down in case the only sell-off we see is a garden variety 10 to 20% as opposed to a generational 50 to 80%. The trick is planning. I always say I can predict which way the market's going to go tomorrow. It's going to go up or it's going to go down. The trick is having a plan for both directions.